Greetings. Let me welcome you to our traditional beginning of the year session looking at the economic outlook for the year based on the report that the World Bank puts out at the beginning of the year, their prospects report. This year it's called The Global Economy in 2025, How to Manage Uncertainty. And that seems like a understatement of a title. And the way we are going to do this is that we like to start with a presentation by Ehan Kosh. Ehan is the director of the Global Prospects Group at the World Bank, the deputy chief economist, and it's his team that puts together this prospects report and series of other really very good analyses of the global economy, which we have featured from time to time at CGD. We have three panelists who are going to come in after that. First of all, we'll have Nathan Cheats. Nathan is the global chief economist at Citigroup, but Nathan also has had before that a series of important public and private sector roles, including in the U.S. Treasury, where he was Undersecretary for International Affairs. We have Ken Opalo. Ken writes extensively on Africa, on the political economy of reform. Ken is a associate professor at the School of Foreign Service at Georgetown University, and very much looking forward to having both Nathan and Ken give us their perspectives on the outlook once Ehan has presented it. And then we have Liliana Rojas Suarez, a senior fellow here at CGD, and also the director of our work on Latin America. Liliana has also been a regular on these annual presentations and indeed puts them together for this event together for CGD. So thank you for that. So with that, given we only have an hour, what we want to do is start right away with you, Ehan. Welcome. Thank you again for joining us. Thank you for taking this opportunity to present the report. I'll turn it over to you for your presentation.
Thank you, Masood. It is great to be with the CGD and this distinguished group of colleagues at the panel. I'm just going to show a few slides before we start the panel discussion. We released this report 2 weeks ago. Now I feel it's like 12 months ago. But what I would like to do, I would like to focus on very quickly three major questions. The first one, what are the near-term prospects for the global economy? And I will look at the big picture and then we can discuss the details. The second one is related to what we did in this report. We took stock of the performance of emerging developing economies and low-income countries in the first quarter of this century. 2025 is the last year of the first quarter. We thought that this is an opportune time to do that. And finally, I'm going to turn to the question, what are the policy priorities? And I will use these acronyms, EMDs, that stand for Emerging Developing Economies, and LICs that stand for low-income countries. So let me start with the first question. What are the near-term prospects? When you think about how global economy has performed since the pandemic, actually it has been remarkably resilient. And we think that that resilience will be with us for the foreseeable future. Last year, global growth was around 2.7%. This year, we think global growth is going to be again 2.7%. And there are good reasons for that. Inflation is coming down. Many emerging developing economies around the world, as well as advanced economies, central banks, reducing interest rates. We think that trade will pick up a little bit more this year if things go well in the way we are envisioning. So all in all, the near-term picture, I would say, stable. But when you put it in a broader context, there are, of course, significant challenges. And the most important challenge is that growth we have, this 2.7%, is actually much lower than the average growth we had in the decade before the pandemic. That growth was around 3.1%. Briefly, when you look at advanced economies, you see that stability around 1.7% growth. Again, lower than what they delivered prior to the pandemic, still quite resilient. And there, the US economy is critical. Last year, US economy delivered growth around 2.8%. This year, we think it will continue to deliver growth around 2.3, if not higher, given the kind of the productivity growth, given the resilience of its consumer. When you look at emerging market developing economies, growth there is hovering around 4%, rather weaker than what we had prior to the pandemic. But if you take out China and India, you see a little bit of pickup in growth, primarily because of we are expecting consumption and investment accelerate in these economies. China will continue having its gradual slowdown, but there are some emerging markets delivering respectable high growth numbers. Now, this stable but lower growth comes with significant downside risks, and that those risks center around one fundamental issue we have been seeing in recent weeks: adverse policy shifts and heightened policy uncertainty. Policy uncertainty has a significant negative impact on growth at the global level, at the country level. And of course, it's going to be important to reduce that policy uncertainty in the coming weeks and months. Is this surprising? Not necessarily so, given the number of elections we saw last year. And these elections brought, of course, new governments in charge, and they need to formulate their policies and implement them. One of the important uncertainty we see centers around trade, and that's related to the trade fragmentation and the risk of fragmentation becoming even deeper because of the policy disputes we see between major economies. And that casts a long shadow over our forecast. Trade has been already slowing. Of course, there is this possibility of a deeper slowdown if we see these challenges continue. Another important risk, of course, conflict and geopolitical tensions. We have conflict in Eastern Europe, still challenges in the Middle East, a number of actually challenges in Africa as well. And beyond these, we have still sticky inflation. Our headline forecast suggests that inflation will come down at a slower pace, but there is this possibility of, especially we see in the US, prices of services remain rather sticky and Fed pausing. With that, if interest rates remain high for a longer period, there's the possibility of financial stress, and that's very important for the group of countries we are looking at, emerging developing economies, because some of them have heavily indebted, and they are already suffering from this rather sizable debt service requirements. And of course, climate-related disasters, the frequency is becoming higher, the cost is becoming larger, and that risk also is a critical one we are monitoring. There are at least two upside risks, having mentioned all these downside risks. One is that we might end up seeing faster monetary easing if inflation comes down at a rapid pace. That is a possibility, especially in some advanced economies, some emerging developing economies, that will ease financial conditions. Another important upside risk, we see US economy surprising on the upside as it did before, given the basically tailwinds it brings with productivity growth, with very still healthy household balance sheets. And of course, when you think about China, policymakers made some promises last year, delivered those in the context of policies. If that continues, China can also surprise on the upside, and that will lead to higher growth in the near term. With that, let me turn to the second question. How have these emerging developing economies performed in the first quarter of the 21st century? Now, when we think about what these economies have done, they have done many things remarkably well, but there are certain things really troublesome. in the first decade of the century, they delivered phenomenal growth. And in fact, the highest growth they have delivered over the past 5 decades, around 6%. When we think about what happened in 2000s, that was an era. Basically, there was global consensus about opening up, integrating, undertaking reforms, improving fiscal frameworks, improving monetary policy frameworks. With that, these economies delivered phenomenal growth and made significant progress when it comes to poverty reduction. As you see on the left, with that, significant achievement, their contribution to global growth doubled. In the basically 90s, they were contributing less than 30%. Now they're contributing actually more than 60%. They used to trade a lot with each other. Now they are trading even more with each other. Of course, with that, spillovers associated with growth in these economies, as you see in the middle panel, have increased over time. So they have larger impact on other economies, especially the big emerging market developing economies. But after 2000s, this growth reform basically lost momentum. Trade slowed, investment slowed, demographic challenges in some of these big economies become more pronounced. With that, growth slowed. And you see it on the right panel here. In the 2000, growth was around 6%. You come to 2010s, growth declined around 5.5%. Now 2020s, it is basically around 3.5%. If you look at long-term growth prospects, those have declined dramatically as well. So they have done many things right. They were able to put together strong growth performance, but looking forward, there are significant challenges, especially on the policy front. Let me quickly talk about low-income countries. Low-income countries have per capita income less than $1,145 per year. That means, around $3 per day. At the beginning of this century, we had around 63 low-income countries. In 2000s, the number of low-income countries declined quite rapidly. Now we have around 26 of them. And there's a big difference between those countries that basically graduated, these LICs, they turn middle-income countries, you see in the middle panel, and those low-income countries still in the low-income category. As you see, these countries, they turn middle income, they were able to deliver much faster growth. Those, they stayed stuck in the low-income category, their basically per capita income hasn't changed over the past 15 years. There are many reasons for that, which I will talk very briefly, but going forward, graduation prospects have darkened in the sense that if we basically extrapolate their performance, what they have done so far in the first quarter of this century, we think only 6 out of 26 low-income countries have a shot at graduating by 2050. So what is the big challenge there? 70% of these low-income countries have to deal with conflict and fragility, as you see on the left. Those graduated, they had much better environment. Of course, when you have conflict, it becomes much more difficult to have this sustained growth acceleration. So almost all of these economies, they were able to graduate. They delivered high growth year in, year out for an extended period of time. For these economies, the low-income countries that stuck in that category, it is very difficult to do that unless they overcome, of course, this conflict fragility challenge. There is another big challenge they face. These extreme climate events, they are much more frequent in these economies in the form of droughts, storms, and floods than other economies. So climate change has a huge impact on these economies with lower income. So let me turn to the third question. What are the policy priorities given the performance we see? So there, we see multiple growth opportunities. I'm going to talk about one opportunity when it comes to reforms in the context of broader emerging developing economies, one opportunity when it comes to labor markets in the context of labor markets, in the context of low-income countries. As you see on the left, a number of countries made progress in terms of mobilizing government revenues, the public revenues, increasing the tax revenues over time. But many of them haven't made enough progress or they regressed outright. So the government revenue to GDP ratio hasn't changed much if you basically all the way go back to 2000s. On the other hand, government expenditure has increased significantly in some countries, and debt stock has become much larger. In emerging developing economies, as well as low-income countries, we have the highest debt levels, basically, of the century in 2024. So there is significant room to improve fiscal positions through reforms on the expenditure side with efficiency, on the revenue side with mobilization and expanding the base. In the context of low-income countries, they have also incredible opportunities. One important opportunity is their young population. As you see on the right, the rest of the world is aging and aging rapidly. On the other hand, these low-income countries are going to bring the young entrance to the global labor markets as far as the eye can see, all the way to 2070s. It's going to be critical to educate this young entrants. It's going to be critical to provide the health services to these young entrants. Of course, it is going to be critical to equip them with the skills and make sure they have these jobs. That's a kind of a huge challenge, but it can be done. It was done before. Now, what is the big policy message of this exercise, the stock-taking exercise? There is no miracle pill when it comes to economic growth. There is no Ozempic you can take and have this, results in many dimensions, improvements in your health. But there is significant room to improve policy frameworks, to improve institutions, to improve investment climate. And we think that there are significant synergies among policies. Take, for example, investment climate issue. If you improve investment climate, you are able to bring FDI. Take, overall climate challenge. It's all about infrastructure investment needed in these economies. If you are able to mobilize public sources as well as private sources, you can mitigate the climate problem while contributing to economic growth. There are many things they can do at home, but the global cooperation is also key to overcome many challenges these economies face. So let me summarize. The first question I ask, what are the near-term prospects for the global economy? We are expecting global growth to remain stable, not sufficient enough to make good progress. And there are significant downside risks, especially heightened policy uncertainty and growing trade fragmentation are the risks we are focusing. The second question I ask, how have these developing economies performed in the first quarter of this century? There was strong growth and rapid integration in the 2000s. That era made a huge difference. That expanded the role of these economies, and they basically deliver much larger spillovers. Since then, these economies, including low-income countries, have been confronted by a wide range of challenges, including weaker growth, loss of reform momentum. Climate change is more pronounced as a challenge, demographic shifts, and of course, global trade tensions. And in the context of low-income countries, we are quite, concerned about their ability to graduate to middle-income levels. And the third, what are the policy priorities? As I said, it is going to require huge effort at the domestic level to overcome this, the subdued growth environment, and it is going to also require global cooperation. Let me end with one observation. I invite all members of the audience to visit our webpage and take a look at our publications. We discuss these issues in different publications in detail and provide solutions. Back to you, Mesut. Thank you.
Thank you very much, Ayhan. Thank you for being clear and sticking to the time. And I think you've laid it out very nicely for us. I'd like to start off with asking each of the panelists to let's have a quick round focusing on the near term. And Ayhan kind of laid out the near-term prospects, stable, not quite where they need to be to tackle the challenges, but also a lot more uncertainty. And obviously, that uncertainty has probably grown since the time that you put this report together, Ayhan. So I'd like to start with you, Nathan. Maybe let's take a big picture, global look at the OECD, the rich countries, because obviously what happens in the US, what happens in Europe has a big impact on not just global outcomes, but on looking at the environment within which emerging markets and developing countries need to operate. What's your sense of how to look at 2025?
Well, I think Ann has laid it out very nicely. And much of the language that he used is language that I use in describing the global economy, and particularly this term resilience, that we've been surprised over the last several years at the ongoing, and his point that I can't say strength, that we're still below a trend is well taken. But nevertheless, I think given the shocks, I would characterize it as ongoing solid performance. That we have seen a global economy that's manifest an ability to shake off shocks. I also agree with his observations that the upside surprises have been the most remarkable in the United States. And I'm really convinced that the US economy is now growing, that there are two engines that are propelling the economy forward. First is we have a very strong consumer sector, and particularly the top 40% of the income distribution are in a very good place and are spending vigorously. But the rest of the distribution, folks are continuing to be employed and they're spending. And then in addition, the corporate sector has been strong. So all in, the U.S. economy has been solid, and at least absent major shocks, is likely to remain so. I think that much of the rest of the developed market universe has been much softer. Let me say a word specifically about the euro area, where in aggregate, we've seen over the last year or so 1% growth, a notch below our estimate of potential, which we expect is going to open the door for the ECB to continue to cut aggressively through the coming year. But I think maybe the more interesting point for Europe is a divergence of performance, where the north, the manufacturing countries, particularly Germany, are really struggling. But in contrast, the southern services producers like Spain, Portugal, Greece are actually doing quite well. And I think they're benefiting from the strength in services spending, and also from the fact that coming out of the peripherals crisis, they implemented significant structural reforms. So kind of the US has been the standout. The euro area, and I won't go into detail on the UK, have been softer. Maybe a little bit of a bounce this year in Japan on the back of ongoing quite solid or even strong wage growth. Is likely to support spending there for a while. So when I put that all together, I'd say a fairly encouraging outlook, a non-disruptive outlook based on just the fundamentals for a backdrop for the emerging markets and developing economies. Of course, the final point that I should emphasize, as you have as well, Masood, is that the policy uncertainty here, the tariff uncertainty is significant. I think it's hard to parameterize it, and I think it's really all we can do for now is just kind of put on our seatbelts and just kind of wait and see how that plays through. But I would emphasize that this policy uncertainty is happening in the context of a global economy that's shown itself pretty resilient over the last 4 or 5 years since the onset of the pandemic. And I'm at least hopeful, if not confident, that that resilience will continue to manifest itself, even in the face of some of these policy uncertainties that may manifest themselves this year.
Policy uncertainty won't have the same kind of impact because we're starting out from a resilient place, but clearly it's going to have an impact not just on the developed economies, but also on emerging markets that are more integrated through trade. They're integrated now increasingly through financial markets. I want to turn to Liliana next. Liliana, I want to get a little bit your sense of, you heard what Ayhan was saying about a little bit your sense of how you're thinking about the coming year for emerging markets. If you're an emerging markets policymaker, whether you're in Latin America or you're in Asia, how should you be thinking about this year?
Thank you so much, Masood. First, let me join you and the rest of my colleagues to congratulate Ayhan and his team for another great report this year. Masood, as you have mentioned, there is a lot of uncertainty now regarding the short and medium term for emerging markets, since the global economy will be affected on how these tariffs imposed by the US and the retaliations play out. So the whole thing is still unknown, but uncertainty is there. However, I think there are several reasons why these events could have significant impact. First, uncertainty in itself is a global shock. The shock to the global trade is a new shock to the growth prospect of emerging markets. So just when, as everybody has said, when a good number of emerging markets have been in the process of rebalancing fiscal accounts and rebuilding buffers, here's one more global shock on top of the multiplicity of shocks since 2020. I think that history is going to call this period a quinquennium of shocks. Regardless of how these trade shocks evolves, however, I think it's going to have a long-lasting effect because now countries will face long-lasting uncertainties regarding how and when tariff and other sanctions may be imposed on them. Increased tariff put pressures on the inflation rate in the US and abroad. And this is something that is going to be in the mind of policymakers. You know, some experts, based on the 2017-18 experience of tariffs during the previous Trump administration, the tariffs on China, some argued that that tariff won't have an effect on inflation. But we are now in a completely different economic cycle where inflation expectations are really quite sensitive to news and can easily be de-anchored. If there's an increase in inflation in the US, this is also bad news for emerging markets, since imported inflation is a non-trivial component of the inflation rate in many emerging market economies. And many traded goods are denominated in US dollars. So what is happening right now is that, driven about concerns about a potential new bout of inflationary pressures, a number of central banks from emerging markets, including those from Latin America, that were on track to reducing their policy interest rates, now they have put interest changes on hold. So their expectation of higher inflation could actually get an impetus once again fueling actual inflation. So this uncertainty is really putting pressure on the monetary policy of policymakers of Latin America now. One more thing is that since the global shock has the potential to increase interest rates, increase them or keep them high as long, there is also an adverse financial effect on the emerging markets' ability to roll over maturing external debt and to make good on interest payments due. This is bad news for many countries with high external debt ratios, as that's something that the report has highlighted. And that includes, as the report also highlighted, many emerging markets. So related policy uncertainty is really bad for investment, including cross-border flows and foreign direct investment. And many emerging markets economy needs a lot of these type of investments, especially now, given their low saving rates and underdeveloped capital markets. One final point, right? The risk of trade fragmentation also comes accompanied by the risk of increased financial fragmentation. If there is fear of US trade and financial sanctions, this fear spreads to other emerging markets well beyond China and Mexico, countries might tend to shift at least part of the reserve assets away from the US dollars. This is, of course, a much more longer term perspective, but it's a danger, it's a huge risk for emerging markets living under the uncertainty of what may happen with the goods and services that implies the use of US dollars. That financial fragmentation is really bad for the world, but it's especially bad for emerging market economies because not only brings inefficiencies, but could reduce emerging market resilience to external shocks because they could be moving towards other less safer currencies. The US dollar has been for a long time being seen as the safe asset of the world. And these kind of uncertainties of what may happen to me in the future could actually impede the perceived safety of that asset. All right, back to you, Masood. Thank you.
Thank you. Thank you very much, Liliana, for that. I like the way you said that the uncertainty itself is a global shock, is an external shock that countries have to operate with. And they have to adapt and adjust to the uncertainty and watch as it plays out in a way and be more agile. I want to come to Ahan. Am I getting an echo here, I think? But I want to come to Ahan. Sorry, not to Ahan. I want to come before I come to you, Ahan, I want to come to Ken first. And then I'll come to you on that point of uncertainty later. But Ken, I want to get a little bit your sense of how the environment, the external context, is going to impact countries in Africa. And, I recognize, as I hope everybody else on this call does, that when we talk about countries in Africa and low-income countries, the prospects at the moment and their growth rates are so widely different. Some of the fastest growing economies are in Africa, but then there are also them that are struggling. And I think it'd be great to get your sense of how you think the context is going to affect not just the outcomes, but also the ability of these countries to move forward with some of their reform agenda.
I'd like to thank Ahan for such a wonderful summary of global economic prospects in the near term. And I think I'd like also to echo the word resilience as sort of the operative word here, because when the pandemic hit and the following fiscal squeeze hit many African countries, there was a fear that we would go back to the 80s of structural adjustment programs everywhere, budget cuts, and sustained economic decline for a prolonged period. But what we've seen was that the pandemic shock was just a small dip, which altered 25 years of continuous growth in the region on average. And now, most of the region, except for one or two countries, are back on their growth trajectory. The trends are also lower in the region than the pre-pandemic trends, but growth is back more than 3% on average, with quite a bit of variation, which is the second point I'd like to make, that there's 54 countries, lots and lots of variation across the region. You have the conflict-affected fragile states, if we can call them that, which will continue to struggle for obvious security reasons. But there are lots of countries that are on an upward trajectory that will grow by more than 4, 5, 6%. Your Senegal, Togo, Ghana, Cote d'Ivoire, Kenya, Tanzania, Benin, all countries that will be driven mostly by a resilient domestic consumption base, rebounding in agricultural productivity, and of course gas discoveries and petroleum discoveries in a number of these countries. And so growth will be back in many of these countries because the fundamentals did not shift as much as perhaps many had feared because of the global shocks that we've witnessed over the last several years. And then, I think the biggest laggards as far as the regional economy goes, I think will be South Africa and Nigeria. Right. So the conflict-affected states tend to be smaller economies anyway, without much sort of regional impact. But underperformance in Nigeria, which is a major economy in the region, South Africa, will drag the regional average down and perhaps also dampen their neighbors' economic performance. Nigeria is going through really painful structural reforms. I'm not sure if politics will allow the president to persist along this path. But Nigeria really needs to reform and access to energy, improve its infrastructure base to be able to provide the platform for a competitive regional economy that can then also help power the performance of its neighbors. Similarly, South Africa also needs to reform its energy sector, as well as domestic policy to be more pro-growth. In the sort of medium term, I see the same shocks presenting potential downside risks. Higher interest rates, of course, will mean even the well-performing, high-growth countries will struggle to access affordable debt. It is true that African countries cannot save their way out of into growth. They will need to borrow money to the extent that high interest rates in high-income countries, because perhaps of inflation, will mean that they're not able to access credit and therefore will not grow as fast as perhaps they would have. The other risk will be related to commodity prices. There's definitely a live possibility that trade wars and related sort of geopolitical tension will dampen commodity prices, which of course will have a knock-on effect on African countries' ability to grow fast, given their very high dependence on commodities. So that's my sort of continental view. Lots of variation, but also quite a bit of resilience, given the shocks that many of the countries have faced. And then to conclude, I think regional sort of reform efforts will also be tempered by politics. As many of you probably know, the continent is a very young region. So many African countries will continue to struggle with the twin pressures of, trying to balance the books, reducing deficits or keeping them low, while also facing enormous pressure from a young and growing population that requires investments in infrastructure, in schools and hospitals and whatnot. And so the pressures from below may sort of force consumption spending, government consumption spending, to be higher perhaps than is optimal for allowing space for domestic private credit growth and a private sector-led growth process. And related to this, will be shocks like, climate-related shocks, which I think the global environment, if credit access becomes easier, it may allow African countries to borrow and invest in infrastructure for climate adaptation purposes. But if that's not possible, right, the internal crisis will snowball. So the political crisis will, say, climate emergencies like floods. Governments will not be able to respond to them, which will in turn generate political crises, which in turn may sort of unravel the political consensus that I think is core to the growth prospects of many of these countries. So overall, right, two key points. One is resilience, right? This will not be the 80s, as I like to remind everyone. African countries are much stronger now than they were back then. Policymaking expertise is much better. Economies are bigger, more outward oriented. They're better able to absorb and weather shocks. And then, of course, quite a bit of variation on the back of that. Back to you, Masood.
Thank you very much, Ken. I want to come back to you, maybe just to reflect a little bit on two questions in a minute. One is that the big economies in the continent are the ones that have been slower growing. So it'd be interesting to get a sense of, whether you see, you talked about Nigeria, but if you look at South Africa, you look at Ethiopia, some of the big economies have been a bit slower than others, and how do you see prospects for them? And the second question, which I want to get also a sense from you and from Ehan, is the conflict countries. You mentioned they're not big in terms of the aggregate weight, but for the people who live there, it is a very important set of issues. So I want to come first to you, Ehan, and then I'll come back to you. Ehan, you mentioned that only 6 of the low-income countries over the next 25 years are likely to graduate. And then you also mentioned that actually many of the ones that are there now have conflict. How much of this is a story which is of conflict-affected countries and countries that have varying degrees of fragility being the ones where economic progress is being held back? Or I'm just trying to get a little bit of a sense of how you see the overlap between conflict-affected countries and the ones that are not performing well.
No, thank you, Masood. When we think about these 26 low-income countries, 17 of them are what we call fragile conflict situations, basically. And when we think about the fragility and conflict, when you have them, it is when you have the kind of the conflict, it's very difficult to have macroeconomic stability, if not, impossible. But the big picture is that when we look at the past 25 years and zoom in the kind of the low-income countries of today, and out of this 26, by the way, 22 are in sub-Saharan Africa, I think it's not an exaggeration to say that they are facing something of a perfect storm. They have acute challenges at home regarding fragility, conflict, and violence. And global environment has also become less supportive of economic growth in these economies against the background of these geopolitical tensions and trade fragmentation. So more than 2/3 of today's low-income countries experienced at least 1 year of intense conflict since 2000. So that should tell you the kind of the big challenge we have when we think about the fragility and conflict. In terms of climate-related events, low-income countries have about 50% more droughts, storms, and floods per kilometer than the previous group that basically graduated. So you have conflict, you have climate change, and when you think about that distress, half of them are already in that distress, and none actually basically are out of the kind of what we call risk of debt distress. So there's this huge issue when it comes to debt and the need to overcome this debt problem. And of course, against the background of all of these challenges, it's difficult to talk about a productive economy and productivity growth. So in a nutshell, these economies will require economic interventions. There is no question about that. But also broad global interventions by the global community to overcome the conflict and then provide an environment supportive for economic growth. Now, what is important here, as much as there are many reasons one can be pessimistic, there is one good reason to be optimistic. When you look at some of these middle-income countries, they used to be low-income countries before, they had conflict, but somehow they were able to overcome that conflict and deliver sustained growth for a period of time, and that made all the big difference. I think what we should remember, in 2000, India, Indonesia, Bangladesh, they were low-income countries.
Right.
They are not low-income countries now. So there is hope at the end of the tunnel, but it will require to bring together the global community and very serious drive at home. Back to you.
Thank you. Thank you very much. Let me come back to you then, Ken, just to get quick reaction to that. I'm conscious that don't have that much time, but just to get a quick reaction from you to what I have just said about the conflict affected countries.
Yes. So I think Anne is spot on that many of these conflict affected countries are facing the perfect storm of crisis. And I think one of the binding constraints to their recovery is both geopolitics, emerging geopolitics, but also I think the poverty of the toolkit available for the international community and international institutions to engage their governments, right? So if you look at, say, an example of a country like Syria right now, which is emerging out of a conflict, I think the global community has been very much willing to look over many sort of obstacles to engagement, direct engagement with the current government in the name of rushing to stability, which I think is a smart move, right? Because for many countries, the biggest crises emerge when they take too long to get to stability, and therefore basically develop what I would call conflict economies that are self-reinforcing. So the faster you can get to stability, the better. Then you can build something around the stability. Because at the end of the day, again, as Anne pointed out, right, you just need to grow and stay stable long enough to get into this self-enforcing trend. And so I think the challenge for the conflict-affected states in Africa is that response hasn't been nimble enough to their localized challenges to stability and insecurity. And because of that, they've been left to their own devices. Regional bodies have not been strong enough to step in, which then created conflict economies, whether you're talking about the wider Sahel from basically the Chad, the Central African Republic, Sudan, all the way west to Mali, Eastern Congo, right? The emerging crisis in northern Mozambique, which everyone should, be trying very, very hard to nip in the bud, if we can even call it that now, given that the conflict has become much larger than it was only a few years ago. And so this failure to respond fast enough and comprehensively enough before these conflict economies emerge often means that response comes a bit late in the game, and therefore, more investments are needed than the international community is willing to provide. And then once you're stuck in that conflict trap, right, it becomes very, very hard to come out of it, because each crisis just adds on to what existed before it.
Great.
Back to you, Masood.
Thank you very much. No, that was really helpful to get us to understand in a way, the complexity of this, and also the degree to which these situations vary across. We have just a few minutes, and I want to come back to you, Nathan, if I can, please. And we didn't talk about one big change one big player in the global economy, and what's going to happen there, both near term and medium term. And one thing that always strikes me is you look at any projection of where the world is going to be in terms of economic shares 25 years from now, or you see very big changes, and obviously a lot depends there on what happens to the economy in China, what trajectory it's on. So quick reactions from you, please, on China, both prospects near term, but also risks medium term.
Yes, absolutely. China is very much front and center, as you say. It's a country that we spend a lot of time thinking about. My sense is that over, say, the next year or two, that China's growth is likely to continue roughly in a 4 to 5% pace. I don't think it will deviate too much from what we saw last year. If it seems like it's going to be much slower, I think the authorities will step in with additional stimulus. In contrast, I think the real questions and the real challenges for China are out over a 5 to 10 year horizon. And I think one of the problems that they have that's very front and center is that as their consumers are looking out over the medium term, these households see a lot of worries and have a lot of concerns about where things are headed. First of all, they see a very weak real estate market. And the reality is that Chinese households have invested disproportionately in real estate. And as you have this unwinding of house prices and real estate prices there, it's creating adverse wealth effects for Chinese households. In addition, the economy is burdened with heavy indebtedness and leverage, and that's more and more a headwind for the economy and a constraint on the extent of fiscal policy. I think that's one reason why the authorities have been somewhat less vigorous. And then there are legitimate questions about where the engines of growth in the Chinese economy. Certainly doesn't feel like it's going to be the property sector anymore. I think Xi Jinping would like it to be exports, but I just don't think China's going to have access to the global market in the same unfettered way that it did 20 years ago when it first acceded to WTO. And then finally, you've got these geopolitical headwinds that are very much front and center and are in various ways constraining China's development. And so when I put all that together, I think that medium-term outlook is likely to be quite fraught. And I think we will see a further deceleration of Chinese growth going forward. Maybe just one final comment that's just a little more upbeat is that over the last week or so, China has reminded us that there is a lot of sophisticated research and investment that's going on there with these recent breakthroughs with DeepSeek. So, the flip side of all of that is innovation is happening. And innovation is a very important upside for many economies. And I think that remains the case for China.
Thank you. Thank you very much, Nathan. I'm waiting for the year when this beginning of the year panel is entirely done through DeepSeek or some version of it. None of us will need to provide inputs. But until we get there, I take your point that this shifting pattern of Chinese economic growth from export-led to more domestic, more consumption based is a conversation we've been having for a decade now. And in some ways, a lot of that path still lies ahead, but it may be harder to sustain the export growth. And it's not just a US-China issue. It's, I think many countries are going to be focusing on their trade relationships with China going forward. Liliana, you have the last word, and I want to come to you to ask, if you look at the medium term for emerging markets, I remember you and I have had this conversation about Latin America, the slowest medium-term growth prospects, not enough investment happening even to replace the existing stock. You heard Ehan say that the medium-term growth, the projections have been progressively brought down. Are you feeling now, where do you come out in terms of, do you see that opportunities to pick that up, or are you thinking that the numbers are going to remain low? What are the factors affecting that?
Well, okay, so something that is in the report too is that there is an important gap that is not really closing. It is the income per capita gap relative to advanced economies. In a region like Latin America, for example, you need a growth of about 5% per year to start closing that gap. I think this is a very hard goal to achieve in the foreseeable future. Growth fundamentals have not really changed too much across the emerging markets category. And if we focus on Latin America for a second, that growth prospects are not really that encouraging. What we have seen is that there is a big dichotomy that I've also pointed out in the past between macroeconomic stability and economic growth, right? I mean, it's a clear agreement between, there is consensus between policymakers and the population that inflation needs to be fought against, it needs to be combated. Interest rates increases are accepted as a policy tool to fight inflation, but that's where consensus stops. There is not really more consensus for deep growth enhancing reforms, right? Especially in areas like the labor markets, right? Where issues like informality goes beyond Latin America, is
Right.
present in many other countries. But there is, of course, one big opportunity, and that relies on the green transition. That is the opportunity that can be definitely exploited by Latin America, given so many minerals and rare earths that that are needed for the green transition. And that could bring the opportunity for those reforms. So really, my view and my hope for the region and for many emerging markets rely on the new advancement, new things that are happening on the global economy related to the green transition, to artificial intelligence advances, as Nathan has mentioned, and that kind of the new prospects for making reform, as opposed to the traditional places like labor market reforms, education reform, which I don't think is moving that quickly in the near future.
Thanks for ending on that optimistic note. And I should just say that I think I personally have been really struck, including in the conversations and the panels that took place at the World Economic Forum meeting in Davos now 2 weeks ago, at how much potential people see in terms of the positive impact of technological developments. I mean, we talk about AI the most, but it's not just AI, it's robotics, it's in life sciences, in a whole range of areas. There is technological progress happening, which if you can just make sure that it is available broadly and is spread across, it's not just the invention, but the application is fast, it could really then give a boost to economic growth and to the pace of human development in ways that we haven't yet fully factored in. We will follow that more in the year to come and report on it. But for now, what I would like to do, we're just running out of time, is to thank all of you and thank Ehan and your team for having put this together. We hope to continue this this tradition in the future. And given the pace at which the world is changing, maybe a mid-year report might be in order. And we will certainly be in the market to have a conversation on how the uncertainty is playing out and the balance of that on economic outlook. I hope that all of you who were watching this found it useful, and I want to end by thanking our panelists. So let's give them a virtual round of applause. Thank you.